and good to see everybody. Happy to be here. I thought we would run through a couple of thoughts around how we are looking at the markets. And as the title suggests, we're navigating volatility. So the markets have been volatile, and this is a little bit around how we are thinking about it, right? So let's just dive into it. Let's see. 1 second. Okay, let's move ahead. I will just go straight up and talk about what we are seeing in the markets itself. The agenda, we'll talk a little bit about the growth story. We'll talk about kind of what's going on with market volatility itself, and then why asset class diversification is important for us, right? So let us move forward. Now, markets have clearly been exceedingly volatile, right? I mean, if you look at it from September 2024, the markets have seen a pretty decent correction up until the first week of April. That is where a lot of the concerns around kind of US tariffs, potential trade war with China, all of that essentially peaked. Now, what has happened since April 7th? If you see, huge recovery. So if I go back a slide and show you, Nifty, small cap, mid cap were both in bear market territory. Large cap also was down 15%, right? Bear market officially is 20% down, right? Now, if you go ahead, you see that the recovery that took place between April 7th and where we stand at the end of June is significant. Small cap is up 25%, mid caps are up 22%, Nifty, the large caps are up 15%. So what does it look like now in total? From September 2024, we now today stand at being only down 4% in small caps, 2% in mid caps, and 3% in the large caps compared to what it was earlier, right? Now let's take a look at kind of what valuations have looked like, because valuations tell also a different story. If you see, this is the large cap valuations. So large cap valuations, if you look at this green dotted line, that is the long-term average. Large caps came down and then have bounced back up to that first line, which is the 1 standard deviation away. The average is 18, it bounced back to about 20, which is 1 standard deviation. This is large caps, right? If you look at mid caps and small caps, it is even more different, right? This is the long-term average for mid caps, which is about 23 times earnings, and the 1 standard deviation is 27, 28 times. They came down, bounced off of the 1 standard deviation, and now started moving up. Small caps have been even higher in terms of valuations. They didn't come down to the long-term average. They came down and then they bounced up even higher than what they were. So today's small cap valuations seem to be at a much higher level than they have been in the last 10 years, right? Now, there's a whole bunch of things. One of the biggest factors, as you know, in the market volatility has been around tariffs. And how is India positioned in tariffs? So if you look at India overall, right, we have a pretty low dependence on exports per se. Total exports in India is about 21% of India's GDP, right? And a big chunk of that, 47% of that is services. So if services are a large part and they are not impacted by tariffs. So India has a pretty low trade issue with the US. Now it is a bigger economy. India is trying to get bigger with the US. So it is an important trade destination for us. But our current issues are not as complicated as some of the other countries, particularly China. Now, we are also negotiating with a lot of our trading partners. You've already seen the agreement with the UK that has been finalized. We are working with the EU as well. And we are working, as you know, with the US. I think we should be able to get a fairly quick resolution to the US transaction. But it is going to be dependent, as our leadership in terms of our ministers have talked about, that it will have to be along what we do and what is in the best interests of India. Now, services I talked about are not impacted. We have relatively low reciprocal tariffs. The biggest change also in the last few months has been around on the monetary and the fiscal side. So on the monetary side, RBI has made it extremely accommodative. They've lowered interest rates, which has made it a lot easier for our economy then to start increasing the credit. Right. So you've seen deposit rates come down. Hopefully, lending rates will come down for corporates. That will increase corporates' activity in terms of capital expenditure. If you look at it on the fiscal side, we have in the budget itself, we've reduced, now we've expanded reduced tax rates, we've expanded the limit, the income limit before where taxes start hitting the citizens. So all of that is helping putting more cash back into the hands of the citizens, and hopefully that will lead to more spending. Now let's talk a little bit about kind of what is India's growth likely to be and how is that resilient, right? India continues to be one of the highest growth markets and economies compared to any of the larger economies, right? So if we are talking about today, the estimate is around 6.3% for 2026. It has been brought down to 6.2% for 2025. Right? So 24 we were at 6.5, it's come down to 6.2. Now, whether it is 6.2, whether it is 6% also, we are still going to be growing much faster than the larger economies. So if you look at on this slide, what we have done is seeing what our ranking is. In 2024, we were ranked number 5 as the 5th largest economy. Above us is Japan, Germany, China, and the US. We are currently have already gone past Japan. Right? So Japan, this is supposed to happen in 26. Today we have almost gone past Japan already. Right? So if you look at this, by 2027, we should be the 3rd largest. So the only 2 economies that are larger than us will be China and the US. And the reason for that is the growth rate is significantly higher than either Germany or Japan. Now, when we talk about market volatility itself, what has happened? What has changed? Right? If you look at it, so some of the impacts let's talk about, right? So we've had union budget, we've had elections in India which have been relatively positive. We've had US elections where it is basically now out of the way. We have a president in there. India is still a resilient economy. Inflation is very much under control. Now let's look at some of the negative issues. Israel-Hamas war right in the middle here. That is the biggest factor here, right? Then if you look at the potential slowdown in GDP, right here, that is another concern. This tariff wars is a definite concern, right? So these are some of the concerns. Now, what are kind of neutral events for us? Rate cuts in the US potentially, that could be a neutral, and then global sentiment we have to watch. So there are a number of things that are going on that are going to, in our view, increase the potential volatility that we have. So the question you have to ask is now, what is the next thing for which asset class makes sense? So our view is that you want a diverse mix of asset classes. So whether it is equity, whether it is debt, we also think that you want to broaden that out into commodities. Now, what are commodities? There is gold, there is silver, there is copper, there is oil, there are different commodities. And when you bring all these different asset classes together is when you see portfolio performing with a lower level of volatility. Right. So now if we look at kind of what have the traditional asset classes been, right? You've got equities that are meant for growth, potential, you have debt that is meant for stability, and then you use commodities which act as a hedge against inflation. Right. So when you mix all these asset classes together, those risk profiles balance off each other, bounce off each other. And the reason they do that is because the correlation between asset classes, if you have negative correlation, meaning if equities go up, which is what you're seeing with the Nifty, gold tends to go down. So it is negatively correlated. If equities go down, gold tends to go up. Similarly with debt. If equities go up, debt tends to go down. Right? That's what a negative correlation. So essentially you want asset classes that are negatively correlated so that you can bring down the overall risk in your portfolio. So a diversified portfolio is what will help you reduce your volatility. So what we've done is we've looked at kind of the last 21 years, right? And you've seen basically the observation is that winners tend to rotate, right? No asset class has been number one every year, right? But if we look at this for the last 21 years, what have we seen? Equity has been number one 10 of the years. Gold has been number one 9 of the years, and debt for 2 of the years. But what you'll notice is that consistently multi-asset comes in number 2. So 13 of the 21 years, so almost half the time, multi-asset comes in at number 2. So you may not be the best, but you are the second best very consistently 1 out of 2 times, right? Now, if you look at the 20-year history on the chart side, right? If you look at the returns, there you will see there are two big performance areas where gold has outperformed and has helped a multi-asset portfolio, right? So one is in the 2012 2013 time frame, which is when we went through a taper tantrum, and then it is during COVID in the 2020 times, right? You will see while equity has gone down, you would had gold that bounced up and therefore multi-asset. So if you look at over a 20-year period, equities have returned, let's say 14%, 15%, 14.8. Gold has come at 14.8. Multi-asset has been at 13.8. Now, why is this important? Right? Especially when you think about not only is multi-asset important, but how do you rebalance within that? And why is asset rebalance important, right? So if you've had a equally weighted portfolio, so we've taken an equally weighted portfolio and we started with equity, gold and debt. And this is the time frame between GFC, the global financial crisis, that happened in 2007. So we've looked at this saying that our asset weights in 2007 were equal. So your portfolio had 33% of its assets in equity, 33% was in gold, and then you had the balance, the same 33% in debt, right? So you started with an equal. So now let's fast forward. What happened between 2007 and March of 09? Between 2007 and March of 09, which is when the meltdown occurred, you had equities that underperformed and went down 54%. You had gold that went up 50%, and you had debt that went up 9%. So now my weightage in my portfolio, if we had done nothing, your equity holding in your portfolio is now 15% of your portfolio. Your gold is about 40%, 50%, let's say 49% of your portfolio. And if you look at your debt portion, that is now gone up to 36% of your portfolio, right? So that is one. You have not made any adjustments. You have not rebalanced your portfolio. Your portfolio now stands at 15, 49, and 36%. Now imagine the recovery, right? So March 09 was the bottom in the market. Now let's say till October 2010, equities have bounced up 117%. Gold went up another 29%, and debt went up 8%. So your portfolio, because you have done nothing, right? You were at 15%. You started at 33% in equities. You went down to 15% because the markets declined, and then you bounced back. So now your positioning is 24% in equities. Similarly, you went from 33% in gold to 49% because gold performed well in a down market and continued performing well. So you are now 47%. And debt, you went from 33 to 36 to 29% of your portfolio. So if you had not rebalanced at all, which is what this is showing, your overall portfolio return has been 35%, right? Now imagine you have rebalanced, right? If you have rebalanced, your overall portfolio return is 51%. If you've been rebalancing after the market fell down. So in this period, when the market declined, if you had rebalanced and taken your 15% back up to 33% in equity, you had reduced your gold from 49 back up to 33, and you had reduced your debt back to 33, your returns would have been 51%, right? So the comparison between a non-rebalanced portfolio and a rebalanced portfolio is 35% versus 51%. Now, why should we talk about asset class diversity, right? If we look at 20-year rolling 5-year returns over the last 20 years, right? You look at equity, you've had 26 times where it has had a negative return. Gold has had a negative return 165 times. But multi-asset has never had a negative return, right? So multi-asset, the reason you want asset diversification is you are able to balance off that in your portfolio. So if you look at minimum maximum returns in a portfolio that has your minimum return on equity is -1, your maximum return has been 28%, right? So whereas in gold it has been -2 to 29%, but multi-asset you never had a negative return. You went 4% to 20%. So you've always been in that range, right? Now, what does that actually mean? The higher you have a return without the decline, your volatility, right? You perform for every element of risk. Your outperformance and return is higher when you do a multi-asset. So that's called the Sharpe ratio effectively. So you'll see across every major period, right? Sharpe ratio is higher for a multi-asset strategy than even equities or debt standalone, equities or gold standalone, right? So multi-asset on a risk adjusted basis has performed much better than individual assets, right? So let's look at even on the drawdown perspective, multi-asset drawdown is much lower. So the declines are much lower in a multi-asset portfolio than in for equities particularly, right? So now when we're looking at multi-asset in the current environment, right? So we talked about kind of the whole move between Jan 24 in 24 to September 24. Small caps were up significantly, mid caps were up, and gold was up marginally. Now, between September and February 25, you saw small caps decline 25%, mid caps decline 20%, even large caps decline, but gold was up 13%. So it helps to diversify, right? And the diversification, because if you were in a multi-asset, access to gold would have helped you mute the decline in your portfolio. So couple of different quotes. Diversification is the only free lunch you get in investing, right? If you diversify your strategy in your portfolio, your likelihood of having massive declines, if you have a purely equity portfolio, is much less. So the idea behind diversification is to reduce the risk and achieve the same level of growth. So if we talk about kind of just to sum it up, India's growth remains resilient. Global scenarios are going to see increased volatility. Therefore, you need asset class diversification to help reduce this volatility. And I would say investors always should be focused on their long-term goals and how do you achieve those long-term goals. So with that, thank you very much for your time. I appreciate the opportunity and best of luck on your investment journey.